Hey guys, what is up? It's Arthur here. Welcome to the channel, and into this video in which we'll take a look at Coca-Cola and their financials, and at the end we're going to put a price on the stock to see if it's worth what they are asking for it today. I will follow up this analysis with an analysis on Pepsi to give you a better comparison between the two and more context around Coca-Cola. So if you don't want to miss out on that, like this video and subscribe to the channel so YouTube will know to show that video to you. And without further ado, let's get into this. I have a little dashboard here, and on the right side of mine, 10 items that we're going to go through and see how Coca-Cola stacks up, so we get a good first impression of what to expect when you do more research on it and from what angle to approach it. So a lot of green numbers that we can see. The stock has been up lately. We don't really care about the price as much as numbers here and in the financial sheets. So what we can see, market cap of $300 billion. The enterprise value is roughly 10% higher, 332, which means there is more debt in this business than cash, because you take market cap, you add debt and deduct the cash, and we end up with a higher number. So there's more debt in this business than cash. We can see the profit margin for the previous 5 years is 23.62%, 22.7% in the trailing 12 months, in the past 12 months. So it is down. That's a trend we hope will not continue. You got to look into why that might be. Is it stronger competition? Some other reasons why Coca-Cola has to reduce their prices? Or is it something along the lines of the income statement that we will see what makes this profit ratio go down, because that's not something you want to see. Although gross profit margin is up. Coca-Cola does issue a dividend. It's currently 51 cents per share. That adds up to $2.04 per year per share, which equates to 2.9% dividend. And what matters here is whether Coca-Cola can or not pay this dividend. In the trailing 12 months, these dividends, so in the past 12 months, these dividends cost Coca-Cola $8.3 billion. They could not cover that from the trailing 12 months cash flow, which was only a bit more than half of that at 4.7 billion. But if you take a look at the 5-year average, it's 9.5, which does cover it. It does not leave too much free cash flow for other things that you might want to do, because with the free cash flow, we're going to talk about more, but as a forward, what you can do with the free cash flow is to issue dividends, buy back shares, purchase another company, reinvest in the business, or pay down debt. So the more you pay dividends and buy back shares, return value into investors that way, the less you can do to better the business. And this is what I use the augmented payout ratio for, which was over 100% of the free cash flow in the trailing 12 months. So something's not going to be all right in the trailing 12 months. You got to look into that. But over a 5-year period, the average is 87%. Again, it's a little high for my preferences, because there is only roughly 12% of the free cash flow left that the company can use to buy other businesses. As you can see in the 5-year net acquisitions, this is how much company they bought essentially, and to pay down debt and to reinvest in the business. So you want to make sure that even if they are issuing dividends, they can afford that, and coupled with buying back shares, they do not spend a whole lot of their free cash flow. So there is other things to spend that money on. Okay, let's get into this. First in line, we're going to go to financials and take a look at the income statement. Revenue is up from 37 billion up to 45, which is a nice 23% increase. So that's a check mark. We'd like to see increasing revenues. That means we are selling more. We have a better market share probably, and there's just more to do with. If you scroll down the expenses, you will come to net income, which is also up from roughly 8.9 billion to 10.7, which is a similar 20% increase. That is nice to see. And next up, once you take the average of the 5-year net income, I take the average to account for fluctuations within a year. You know, 1 year could be better, could be worse than what the company is usually doing. So I take the average, which is 9.3 billion. You can go back and take the market cap, which was 300 billion, divided 2, and you get a ratio which tells you how many years it would take the company to essentially earn you back the money that you spent, which in this case is going to be 32, which is an X because we want this number to be below 20. Now for premium companies with a lot of staying power and growth potential, you can pay more than that. No one knows how much more, but generally everything above 20 is considered expensive, and then there are justifying factors that you can add to it to justify a higher multiple. In the case of Coca-Cola, I don't know about that, but for that we got to look at the competition and how they are doing. That's what I made this fourth card for, where you take a look at competing brands, competing companies, see what their PE value is, and in that case that is around 26. So Coca-Cola's 32 is more expensive. That's another X for Coca-Cola, is more expensive than the competition, and so that's not a good sign of a purchase, but that is just one of the aspects that we take a look at. Next up, I want to take a look at their return on invested capital. This is not a gap or any kind of generally accepted measure, so different sites might measure it differently. If you're interested in how I calculate it, write a comment down below and I will make a video on it. Mine came to 12.48%. Market average is around 9-10%, so Coca-Cola is earning above market returns on the money that gets put into the business. It's not phenomenal, but it is more than the market average, so that is nice to see. Check mark there. And then next up, another of my favorite is the number of outstanding shares. This is also going to be in the income statement, because once you make your way down to how much money is left from the sales, you've got to decide how many ways you're going to split it. So you're going to go to either basic outstanding shares, this is the shares that are rotating, or diluting shares, which are also included, in which are also included convertible options and like employee stock options and all that. So this is the theoretical maximum. And unfortunately, we can see that we are up from 4.31 to 4.34. Not a big increase, but it's still up less than 1%. It's not huge, but I don't like the tendency. It's a growing tendency, very even. There is a slight dip here, but again, why increase the number of shares outstanding just by that amount? It's not really a good sign, because if you buy into this company over time, you are going to become a smaller owner, so that is something you want to avoid. It's not a huge increase, but it's still an X because we want this number to be going down. Now next up, in the balance sheet, you're going to calculate a value, at least I calculate a value that is long-term liabilities, because if you see the next item on my right, that is going to be, we're going to compare the ratio, or like the rate in which liabilities, debt, grow compared to the revenues. So how this lets you know, or gives you an idea of how they financed their revenue growth that we have seen. And the way you get total long-term liabilities, that are abbreviated LTL, long-term liabilities, is that you take total liabilities, one column at a time, and you deduct total current liabilities, which will give you total long-term liabilities. I take the average of that, and I take the 5-year revenue average that you can see on the first card on the right. You cannot see that, but there you can see that it's under the graph. So it's 23%. And if I reveal to you, long-term liabilities grew by 22% almost. Revenues grew 23%. So you gotta see why that is, because this is technically a check mark. It's not a huge improvement because essentially you took on 20% more debt, 22% more debt, and you make 23% extra money. So there is leverage in that, but you would ideally want your revenue to come from other sources than just taking on more debt. You can also see that they bought a lot of companies, or there are some acquisitions that they did in the past 5 years. 11.5 billion, an average of the free cash flow is 9.53. So given that they spend a lot in a year on dividends, 80% roughly, we saw that they don't buy back shares, instead issue more. So this is only dividends. So they got 12% of free cash flow to pay with, and then they spend this much on buying companies. There is little cash flow to pay down that debt, I feel like. And so you got to see why they are taking on more debt. Is it to finance some kind of expansion, some new factories, some new plants? You got to look into these numbers because this is just to give you a quick idea of how things are looking. All right, next up, we're going to go to the cash flow statement and show you how to calculate that free cash flow that I've been talking about all along. You're going to go into the cash flow statement, and in operating activities, you're going to look for net operating cash flow. Again, column by column, and you're going to deduct capital expenditures. Technically going to add it because this is a number plus minus number. So this is going to be just like the absolute difference of these. You're going to calculate that, and you're going to get an average of 9.5. But what's more important is that we are up from 8.4 billion up to 9.75, which is a 16% increase roughly. So that's a check mark, which is nice to see. And now with this free cash flow, which you can, by the way, if you don't want to calculate it, I think you should know how to, but there is a free cash flow line on the bottom that MarketWatch gives you. So you can also use that. Now, what you can do with this free cash flow, as I mentioned earlier, is you can buy companies, which Coca-Cola does. You can pay a dividend, which Coca-Cola does to a great extent. You can buy back shares, which unfortunately they do not do. You can pay down debt, which might be a tough situation. And you can reinvest in the business, which is questionable how much free cash flow is left to do that, to grow the business really. Right, so you can take the average of that to just use for calculations. There was a big spike in this year. Not sure what happened there. Other than that, it is a nice, even and slow growth. The average is 9.5. And what we're gonna do now, the next metric that I have is that, remember the long-term liabilities that we calculated? In the balance sheet, you take total liabilities and deduct total current liabilities. That was whatever number. And you're going to take the free cash flow, divide the two, and you get a number which tells you how many years it will take Coca-Cola to pay down all that debt. Now, this is a check mark technically because we want this to be under 5 years. This is 4.9, but this assumes that they spend the whole amount of free cash flow on paying down the debt. 5 years is a nice reference point, I feel like. But you gotta keep in mind that they are paying 87% of that dividend, of that free cash flow as dividends, which is gonna leave them in a very tight spot to actually pay this debt down. So this might actually be worse than what the numbers show. So be careful there and do more research on there. And lastly, you can take this free cash flow number that you can see here and also divide that by the market cap of 300 billion, and you're gonna get a value that is 32, roughly very similar to your price to earnings ratio. This again tells you how many years it would take the company at the current prices, at the current free cash flow earning status to make your money back. You again want this to be under 20 to be a reasonable investment. If there is growth, it could be higher, but there is very little growth as we have seen here. And so Coca-Cola earns a 6 out of 10 on this. And to put a price on this company, there are many different variants out there, but we're gonna use a discounted cash flow there. And quickly, while we are at here, let's check our net income compared to our free cash flow. It's very similar. Free cash flow is higher than net income, so that's good. Net income is easier to manipulate, so you don't want that to be a lot higher than free cash flow because that is fishy. Now onto discounted cash flow. Discounted free cash flow it is. So there are a lot of different ways you can put a price on a company. This is called a discounted cash flow analysis, which takes a look at their free cash flow from previous years. This comes from MarketWatch. And then you can, based on that, give assumptions that you can see here, and then project into the future how much that is going to be worth, and consider the discount rate. You can sort of bring that value back to today, because $100 10 years from now is not worth the same as $100 today. So this is what it does. It also gives a value for all the future years. So it's very nice and handy to do. Now we can see that, as we mentioned, the free cash flow is very linear except for this year. So I am fine with using my last year as a starting point for future cash flow basis. I do assume that the growth will halve in the second half of these years. So that is an assumption of mine. You might have your own. And once you sum up all these discounted cash flows, you get a number. You can also add all the debt and deduct the cash. Add the cash and deduct the debt. Sorry, it's all written there, so hopefully it's not confusing. And you get a value that you can then divide by the number of outstanding shares to get a value to pay for this company. With these assumptions, again, I urge you to do your own assumptions and come up with a price on your own. In my case, with my assumptions, this company is worth $44 a share. Currently it is 70. So there is a minus 37% that you can lose on this or make. So that is for Coca-Cola. I will follow this video up with an analysis on Pepsi, so you can compare the two companies. I will leave a link in the description and in the comment section probably, so go check it out. Subscribe to the channel if you want to see more like this. Let me know in the comments what company I should do that you are interested in. And with that, I thank you for your time, and I hope to see you in another video. Bye.